I've been trying to play catch up on the evergreen Spaces conversations on Spotify and Apple Podcasts and all that stuff. So check those out as well. I've been doing my best here to get some traction on the podcast side of things. This should be a really good conversation with Kevin, who's got not only a great following, but obviously a health and experience when it comes to investing, thinking about macro environments that are challenging, like what we're in now, as well as, of course, the precious metal space, which we'll get into. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Kevin Smith of Crescat. Kevin, for those who are not familiar with your background, just introduce yourself. Who are you? How'd you get involved in markets, in particular the precious metal side, and what are you doing with Crescat?
Okay. Yeah. Thanks, Michael. Thanks for having me. Just to give you a bit about my background, I've been in the business for about 30 years. Got into it after business school. I went to the University of Chicago and started with Kidder Peabody back in 1992. So it's been 3 decades, and started building up a high net worth client base. And over the years, broke off around the late 90s to start to be a part of a boutique asset management firm in Denver, Colorado, where we launched a long only large cap strategy and a long short hedge fund. Ultimately, spun the business out of that firm to start my own firm, Crescat, in the early 2000s. And today we're predominantly a hedge fund management firm. We've got 3 funds: a global macro fund, a long short fund, and a precious metals fund that we launched just 2 years ago, which is very exciting. We're macro oriented, so we use macro models and develop macro themes. We're also very much value oriented, and that comes from my longstanding equity value bias. And so even in our macro fund, we have a lot of individual equities as well as the commodities and currencies and fixed income themes. So anyway, that's just a brief background.
All right, let's talk about the long short side for a moment, because there's a lot of different ways of putting together a long short book. Many will know about stat arb, where you're essentially going long one company, shorting another, trying to take advantage of some historical relationship between the two. But there's also obviously a way of doing long short where it's not company specific, but more thematic, where you might be long energy and short tech as the short expression. I'm curious to hear your process on how you construct the long and short side. Is it stock specific? Is it sector related? Talk about that dynamic for a bit.
Sure, we're definitely more of a thematic related firm in terms of building our long and short positions. So the long short equities today are really, it's not a relative value or a stat arb type strategy. It's really more about having both long and short themes that serve as hedges against one another, but you can try to drive alpha and make absolute return on both sides. Not that that's easy, but that's the worthy goal. And today we have an overriding theme at our firm, really, that we call the Great Rotation. And that's really the idea that there's a lot of opportunity on the long equity side of the market in more of the natural resource related industries, commodity industries, and that there's a rotation, if you will, out of large cap growth and more growthy stocks and into undervalued, more commodity oriented equities today. And so we have a lot of, especially with rising inflation and rising cost of capital, rising interest rates, and the excessive valuations in growth equities at large, we see an opportunity for money to rotate out of these large cap growth opportunities and into undervalued commodity stocks. So oil and gas stocks, precious metals, other base metals and other agricultural plays. But that's the basic gist of the Great Rotation idea.
Okay, and we're going to expand on that during this conversation, but I've always interested in hearing how different managers, again, on the long short side, determine their net exposure, because the net exposure can, I would argue, probably is more of a driver of portfolio returns than maybe even the spreads across the long and short. Talk about how you determine your net exposure. Is that something that's based on deal? Is that something by mandate? What percentage typically do you, on average, have in that portfolio?
Yeah, that's a good question. We don't have a specific mandate or express level of low net that we need to get to. And there was a time, I think back starting late 2017, where we became uber bearish on the market at large and actually had an aggressive net short position overall. Because of that, it's something that we pretty much maintained for a couple of years into when the COVID crash came, and that really helped us at that time by having that stance. But it was also, also contributed to some drawdowns along the way that were not so fun. So, having an extreme macro, position, net long, net short, can be good if you have it at the right time. And we do try to, to adjust our exposures based on our overall market views. We have been getting more short recently, but today we have so many opportunities on the long commodity natural resource side of the equity markets that we built such an extraordinary, we think extraordinary, very special precious metals activist portfolio with predominantly within the exploration space, and have a number of gold, silver, copper, even discoveries out there that we're helping to fund these companies and make these discoveries at a time when the industry has really underinvested in both discovery and CapEx for a number of years. I think there's an extraordinary opportunity, some deep value, some high appreciation potential ahead as we enter what should be a pretty big M&A cycle too coming up for this industry. But with the ESG movement and the carbon reduction efforts, there's going to be a major need for metals of all kinds, including gold, silver, copper, nickel. We've got a number of plays across the whole space.
All right, so you referenced the overall market view. Let's get into that from a top-down perspective for a moment. So I named this space. We're in a massive bear market because I've heard you say that on some of the prior podcasts and media appearances that you've done. But I'd like you to lay out the arguments for potentially a very deep decline for equity prices. What type of valuation metrics have you found in your experience? First of all, work and matter, and what are they effectively telling you that makes you think that there might be something deeper coming?
Yeah. So when we look at the value of the overall equity market of stocks at large, and especially the mega cap tech stocks today, we use a number of factors. We look at free cash flow yields relative to enterprise value. We look at PE ratios, EV to sales. We look at, one thing that I'm fond of using, and you'll see me tweeting this recently, is just looking at the top 10 mega cap stocks today compared to those at the peak of the tech bubble in 2000, and looking at on an enterprise value to GDP basis. And a lot of people look at this and they have trouble wrapping their heads around it. But to me, it's really simple that if a company gets so big in revenues, earnings, free cash flow, whatever it is, but market cap especially relative to the overall size of the economy, that this, on average, especially if you take the top 10 of them, that these companies in aggregate, there's no possible way that they can grow faster than the economy at large because they are just too big. And furthermore, when you've had the record stimulus like we've had recently during COVID, and it's no different from the tech bubble when we had the Y2K problem and everyone had to upgrade their computer to prevent their computers from blowing up when the two digits rolled over from 99 to 2000. We were at peak profitability, peak revenue growth, peak everything for the underlying fundamentals. It's really the same thing that we have today. When you throw on top of that peak multiples of the whole group in terms of enterprise value to GDP, which today for the top 10, tech stocks in the U.S., they reach 56% of enterprise. At the peak of the tech bubble, those same top 10 stocks were only 30% of GDP. And, it was the downturn in the economy, led by the spending in those industries turning down that led to the tech bubble recession, and those stocks being down 50% in terms of the S&P 500. 78% in terms of NASDAQ or whatever it was. It's really the same setup today, except the valuations. You can look at it on market, on total equity market cap to GDP as well, the Warren Buffett indicator. These things have all reached excessive values, and there is going to be consequences. And I do believe it's still very early innings in a bear market.
Let's get some of the audience up here. Let's go for a question.
So in our metals fund, we have avoided lithium today. I know it's been very popular, and there's a lot of people have been making a lot of money. In our understanding is that, and this comes from Quentin, who's our chief geologist, is that lithium is is not necessarily scarce. The problem with it is the refining, the producing lithium, and is extremely environmentally challenging, and it's difficult. It's a difficult business, and then technologies on the battery side are always changing. And so there's no guarantee that lithium is still going to be where it's at. So we've avoided it. And I wish I could explain more about the environmental issues with lithium, but for now we're just, I'm just listening to Quentin, and we're focused on the precious metals and copper and nickel and cobalt at this time.
Kevin, have you done any work on, and I've seen this before, and I had a spreadsheet at some point tracking this stuff, but looking at historical sector weightings within the S&P to see sort of what's your range under which the material sector, the energy sector, historically becomes as a part of the larger average, right? So we know that tech is whatever, something like 30 some odd percent or so of the index. It's a lot less for energy, for materials, but there was a time obviously where it was a larger relative weight. Does the sort of relative weighting momentum mean anything in terms of a longer term thesis around the space because of that great rotation idea?
Absolutely. I mean, I don't have all the data in front of me on when in the past exactly that the oil and gas industry, for instance, was a much higher weight. But well, I mean, we know it was in back in 2014, earlier in the 70s, and the two big times that the commodity to equity ratio at large reached extremes. One was at the height of the tech bubble in 2000, where equities relative to commodities had reached a peak. And then it was the beginning of basically a 10-year bull market for commodities. It started in 01. Also, at the end of 1971, with the Nifty 50 bubble and large cap growth stocks at that time, and right ahead of the depegging of gold, from the dollar from gold, and the era of oil embargo. 73, 74 was the beginning of the whole commodity bull market during the 70s. And those were the two times when, if you looked at the material sector versus the rest of the industries, or the energy sector versus all the rest of the sectors, you would see that they'd reached record lows, and we're a very similar place today with this recent everything bubble, whatever you want to call it, but the mega cap tech bubble for certain, which we think peaked at the end of 2021.
Okay, so I'm obviously in agreement because I've been on record many times talking about that sort of longer term commodity secular cycle, especially to your point, that ratio chart that you and Tavi keep putting out, showing the commodity versus S&P ratio. Now, the only devil's advocate part of this for me is, so I understand obviously how it looked in the 70s, and there's a lot of people that will make the argument that that's going to be what's coming for commodities next, but debt to GDP is obviously so much higher than ever before. And I often wonder how debt to GDP impacts cost push cycles, and cost push meaning a commodity cycle essentially. How does let's kind of merge the idea of a commodity cycle with just the state of liabilities broadly, because yes, there's scarcity, yes, there's underinvestment, but now you've got a lot less room to actually do something about it because leverage is so high.
Yeah, as this is credit to Tavi, but he really came up with this idea of the trifecta of macro imbalances today. That never before have we seen this combination of record debt to GDP. It's like the debt to GDP of the 40s, especially when it comes to U.S. government debt to GDP here in the U.S., with the valuations of the tech bubble or the 1929 equity bubble. And that's kind of the second idea on this trifecta. And then the third is the rising inflation side of it. So never before have we seen these three major macro setups happening at the same time. I mean, and truly we have it. We've never had this much debt. The whole what you hear again and again from a number of people, and investors, and even clients and prospective clients, but people on FinTwit, there are so many people that are concerned that we're going to have another deflationary bear market, as that everyone is looking back to 2008 as we call it fighting the last war, that because back then we had this debt problem too, right? Maybe it wasn't as extreme as we have today, but what we didn't have was the inflation side of it. And it was an instance where the debt ended up being more of a deflationary, factor, and even with the record QE that Bernanke gave us coming out of the GFC. But today, the big difference back in 2008, really, for us, looking back on it, was the CapEx cycle. And we'd already had a multi-year CapEx cycle for oil and gas, for instance, and the setup was just very different. And it's why you have to look to other cycles, and really looking back to the tech bubble is more important to us. And looking back to the 1970s, I always believe fundamentally from a macro standpoint that the debt problem, the debt to GDP problem, at the end of the day, can only be resolved with inflation. And I believe that policymakers have an incentive to secretly inflate in order to devalue the debt, and that's the only way that the economy can get out from under this debt burden. And I think this time around in this cycle, that is what we're seeing. But at the same time, the Fed is trapped, and because we really do have inflation, and the Fed has no choice, limited tools in order to address it, and that just all the more makes the likelihood that this bear market is going to be vicious, more probable. And anyway, I can go on more, but I'll just stop talking for now.
No, but let's go with that a little bit deeper, because you often hear that line that you need to have inflation to eat away at the starting debt being as high as it is. But the problem, of course, there is it assumes that inflation will grow at a faster pace than the growth of the debt, right? And unfortunately, as we've seen, every single opportunity that politicians, I think, have, whether it's right or left, to spend more, they will tend to find a way to do it. So it seems to me that argument never really kind of holds true. This idea that, well, you can resolve this debt with inflation, but there's more to the story, I think, than just that.
Yeah, it's not like, it's more that's going to be the end result so much than that's the deliberate in your face kind of policy. And the end result at this point, I think, is more likely really because of the underinvestment in the basic resource side of the economy that's been pervasive for multiple years now. And then the Fed's tools cannot, they can only address the demand side of the economy, as Jay Powell reminded us and confirmed. And so to really stop inflation, I think the Fed is going to do what it's going to do. It's going to keep raising interest rates and cause a recession in order to deal with that demand side of things. But inflation is still going to be there, because raising interest rates is not going to help the world produce more natural resources that we need to make the energy transition, to put food on people's tables, to help people heat their homes, drive their cars. So yeah, you're more likely to see borrowing on the government side down the road, but not before we go through with this Fed experiment of trying to quash it on the demand side.
Okay, so to speak about demand, there is, I think, a longer term interesting demand that's coming in terms of raw materials, which we haven't really seen en masse yet globally, which is the demand that comes from infrastructure, right? And repairing an aging infrastructure, and not just in the U.S., but I've seen estimates that are just obscene in terms of how much actually needs to be done to replace very basic things. I'm going to assume, Kevin, that the difference between a secular cycle and commodities and a super cycle for commodities would be a trend towards rebuilding literally our infrastructure. How does infrastructure trends or spend that could be coming down the pipeline impact where you position a long portfolio that's trying to bet on raw materials?
Yeah, I think it's coming. You've seen some bills pass already, watered down from what the Democrats wanted them to be, but ultimately, when we get in the middle of another severe recession, I think it's going to be easier to pass new spending measures, new infrastructure program, bigger infrastructure plans. I do believe with deglobalization and onshoring that we are going to be bringing more manufacturing back in this country. I think those trends are well underway geopolitically, and we will see it. And so we want to be positioned in the on the metal side for sure, because whether it's silver, copper, precious, gold itself, we really view first and foremost as the primary inflation hedge that investors should have as a core in their portfolio. Gold is used like 11 or 12% of the demand does come from electronics. It is the best conducting, non-corrosive metal that there is. Of course, if it weren't so valuable, first and foremost, for money, for a central bank reserve asset, for investors to have as money as inflation protection, as an alternative to crypto nowadays, maybe just getting back to the core of a non-fiat currency. But metals at large are so critical to this whole energy transition, whether it's battery metals to build the grid, whether it's silver for solar panels, or everything that goes into building out the things that we need. Metals are critical. So I have been a long-running fan of gold. It's probably one of our longest-running themes at Crescat in terms of the global macro fund, as our clients will know. And we've had really good from 01 to 2010, 2011. We've been through a long bear market with it as well. Pretty much a 10-year bear market, I would say. Some people may say it bottomed in 2015, but we've just been kind of bouncing around the bottom ever since, with some fits and starts of trying to get the bull market going. I think the sentiment for gold today is still just abysmal. I don't know why most investors aren't there yet, but to us, it's the valuation that, as you alluded to, that is extremely attractive. Whether it's the majors trading at record low multiples relative to cash flow, the macro setup for the industry at large in terms of the capex that's been in basically a 10-year downtrend, and the number of discoveries that have been in a downtrend as well for 10 years. So when the demand turns, the valuation is there. The values are low. So what have we been doing to try to take advantage of that? We've been trying to buy up as much highly prospective gold in the ground, gold, silver, copper, and other metals. But our portfolios, our precious metals fund portfolio is predominantly gold. It's about 65% primary target of gold. It's exploration focused. So most of the companies in our portfolio are in the exploration segment of the industry, because that's where most of the value can be created, and that's where the deepest value is today. And because we have Quentin Henney, who's a world-renowned geologist, as part of our team now. He's a partner at the firm. He was advising us starting about 3 years ago, and he joined us full-time about a year and a half ago. We just see an extraordinary opportunity to buy cheap gold in the ground and help get money to these companies to build out these deposits and make discoveries. And so that's, the billionaires in this industry, by and large, have made their money on the exploration and discovery side of the industry, whether it's Pierre Lassonde, Ross Beatty, Tom Kaplan, Robert Friedland, Eric Sprott. I mean, this is where the billionaires make their money. And if we can get the macro side of it right and get the alpha on top of it by helping to fund the biggest new deposits on around the world in viable jurisdictions in a diversified portfolio kind of way, that's where we really think we can add the most value and really take advantage of this cycle. But sentiment is dead. Valuations are cheap. There's a lot of deep value and high appreciation potential ahead. When the demand turns, and I believe it will, I think it's going to be the place to be.
By the way, everyone here, please make sure you follow Kevin on Twitter for the remaining 28 minutes here. Again, my name is Michael Agaya, publisher of the Lead Lag Report.
Sure. Well, absolutely, technology and technology stocks are not going away. There will be, many of the companies will be around and will be good investments over the very long term. I'm very concerned about their performance over their likely performance over the next 1 and 2 years. And I think there'll be better valuation opportunities to get into most of these companies. But, if you look at what the top 10 tech stocks were back at the peak of the tech bubble, for instance, the top 10 were Microsoft, Cisco, Intel, EMC, Oracle, AT&T, AOL, SBC Communications. A lot of people, those companies were, like the mega cap techs today. There's only one of them that's still around in the top 10 today, and that's Microsoft. What happened to all the rest of those? So it is a competitive industry. when you get so big relative to the economy at large, you can only grow so fast. And there is, I already said it, but there is competition. And so, you just have to be careful. You have to be careful where you buy, what valuation you get in, and what there is a cycle. There's a business cycle, and then there's commodity versus equity cycles. There's growth stock versus value stock cycles, and I just think it's not that we are more long equities than we are short equities today. We're just long natural resource equities, because very similar to '01 with 2001, that's where the opportunity is. And just be careful out there. That's all I'm saying. I'm not saying, there's going to be, look, the tech bust in 2000, Google and Facebook didn't even emerge until after the tech bust. And there was great opportunities to buy those companies. It was much later. It took a number of years for the whole tech bust to work its way through to the late 2002 bust. And, even then, Microsoft, which is still around today, I don't have the exact numbers, but it took, it went down something like 80% before it went up again. And it took something like 10 years or more to get back to its prior highs from the tech bubble. And I think that's the same situation with any one of these top 10 mega cap techs today. Probably only one or two of them are going to be on top again 10 years from now. And many of them are going to have to go down before they start going up again.
What are your thoughts on these rumblings that the dollar will maybe cede its position as the global reserve currency? How does that impact the commodity cycle thesis if between now and the end game, suddenly the dollar is not going to be as popular as people are used to?
The dollar, a lot of people, first of all, think because we're so bullish on gold and precious metals that we're bearish on the dollar. And like our precious metals thesis, that the name of that theme is called global fiat debasement. It's not the dollar, as much as it is fiat currencies at large that we're bearish on. Of course, that's the whole crypto community seized on that as well, to this argument for crypto versus fiat currencies. To us, it just gets back to gold. But we are not specifically bears on the dollar versus any other fiat currency. In fact, today, because the Fed is really one of because the dollar still is the global reserve currency, and because the Fed is really out in front with the aggressive interest rate hikes and the tightening that a lot of other countries cannot match, unfortunately, whether it's Europe or China. We see the dollar as one of the relatively strong fiat currencies today, and the dollar is kind of the wrecking ball out there right now. And so we're actually long the dollar versus what we view as the most overvalued fiat currencies on the planet. And to us right now, that's the Chinese yuan, and so we do have a short position on the Chinese yuan and Hong Kong dollar through long dollar call options in our global macro fund. And that's, those are trades with big US banks where we're just basically long the dollar to take advantage of a potential depegging of the Hong Kong dollar or further devaluation of the Chinese yuan. We think China is really through its own version of the global financial crisis. Balance sheet recession today. They have an extraordinary amount of debt in their banking system that they have created and are going through their own version of the global financial crisis that we think is about 3 times as more imbalanced than the GFC was. So dollar giving up its world reserve currency status, for what? Which currency is going to take place? We don't see one emerging. We think the dollar is still going to retain that status. The fundamental bullish case for us on the metals is the underinvestment in supply. That's really been a whole decade-long phenomenon. And so, comparing to other cycles, when you've seen much more overinvestment on the metals side, I think there is more downside risk. That's why you really got to differentiate, the type of downturn in the broad economy that you're going into. Is this going to be an inflationary, stagflationary type recession? or is it going to be a more of a deflationary, disinflationary one? And that's why we compare it much more to the tech bust, which was the beginning of a commodity bull market, the beginning of a metals bull market, and that 1973-74 bear market where metals and oil and gas took off at the same time as large cap growth stocks went down. So we see this as a much more stagflationary environment. And once the recession becomes more recognized and pervasive, I do think the Fed's going to have to relent. That will be very for metals, and at the same time as you're going to see more government spending programs to try to address this, the supply side, the infrastructure side here domestically.
I wanted to ask, number one, about gold versus silver versus copper. Maybe sort of thinking about which of those might be a better play, of something that you want to overweight among the three. And then two, which I'll chime in on as well, is the view on long duration treasuries as bear market protection. So gold versus silver versus copper, and then talk about treasuries in a bear market.
So the way I look at gold versus silver versus copper, really has to do, the gold is first and foremost, I think, your money substitute, your real hardcore inflation protection. And, it's a monetary asset. It's a central bank asset. It's an investment asset. Investors have, the sentiment is still extremely negative. We believe that's going to change. Central banks are net buyers globally, but the Western central banks are not yet in the game. Imagine if the Western central banks start buying gold again. I do believe it's going to happen at some point. So gold, monetary metal, while it has properties for electronics and it is used in electronics, and jewelry, of course, demand is big for gold too. But so I look at gold as money. Silver is kind of a hybrid. Silver's been used. Silver's also been money for thousands of years, but it is more used in electronics and in solar panels. So it's really a hybrid. Base metal, precious metal, and then copper, of course, is in everything. So we need copper for everything, the electric grid, electronics. It is definitely much more of a base metal, but I think it's going to be really critical for this whole energy transition. And so, that's how I look at it.
And then the question on treasuries in a bear market. What's the view on treasuries as a diversifier when you need it the most, which is when those tail events in equities occur?
Yeah, so I was like you, Michael, in 2008 except I was, because I was on the other side of it where I was short treasuries back then, and guys like you were right by being long treasuries. And, we've been in a 40-year disinflationary cycle where interest rates have done nothing but go down since the 1980, peak and peak in inflation at the same time. Ultimately, we believe that we are going to enter into a rising interest rate, rising inflation cycle where rates are going higher, including on the 10-year, like they did in the 70s. And we have been short treasuries. I was short treasuries in 08 too. I got it wrong. All the smart money that use long duration treasuries as a hedge, the risk parity strategies. I mean, they did well. That served its purpose. But we think we're entering this great rotation market where, for us, the great rotation is really about the rising cost of capital, rising inflation, being the wrecking ball for long duration securities of all kind, including treasuries, growth equities. And we do believe that the risk is much more that rates will be headed higher, even on the long end, with the Fed, being in the all record stimulus that we have, which we're still going to have a lot of government spending. We still have high government deficits. They've come down. We think they're going to get worse as a recession starts to unfold, and going into QT now, and who is going to be buying the treasuries? And if the Fed's not in the game, we think there is much more risk for rising interest rates even on the long term. We have curve inversions, and you can say, "Oh, that means we're heading into a recession." But we had yield curve inversions in inflationary times too, like that 73, 74, for instance, where the 10-year yields went up at the same time as the Fed was still hiking, and maybe they didn't go up as much, and so the yield curve uninverted. but they still went up, and we see that as a risk today. Look at the long-term chart on the 10-year yield. I mean, it is cyclical, and it does look like it's broken out to the upside. So we are taking the other side of that trade.
I will say it's also worth noting that you can have a bear market where, as we've seen historically, yields rise, treasuries, are lower in price, higher in yield a year from now, just as stocks would be lower a year from now.
There's a safer haven, no doubt.
Right.
Safer haven.
Safer, no, that's right. And I would make that point too, right? It's risk off and
commodities
safer,
have more, volatility. So that if you look at commodities as the alpha opportunity, it's not without volatility, and the treasuries don't have it as much for sure. So it is a safer haven.
On that point about the long-term trend line and the end of the 40-year bond bull market, again, you go back to 40 years, you can see treasuries still act as you said, quote unquote, safer just because of the risk off of default risk, right, with treasuries. But the dilemma that I have with the argument about rates keep on rising, that you've ended the secular bond bull market is, well, I find it hard to believe you can break the secular bond bull market unless you break the secular debt bull market, right? Because if government debt keeps on rising at the pace it's been rising and consumers keep on leveraging, it's not to say it can't happen that yields keep rising, but that seems like an end of the world scenario for the government, right? You've got high existing leverage, high existing liabilities against collapsing asset prices, collapsing tax receipts because of that. Recession risks would obviously put a strain on finances for the government, but then on top of that, higher interest expense, right? Which means an explosion of the deficit, right? I'm not saying it can't happen, but I do wonder if that's almost an apocalyptic bet to some extent.
The other side of it, if the government is going to cap rates, is the explosion of inflation, which we're already starting to see that becomes the consequence. And so that doesn't mean that the government can't come in and do another round of aggressive QE and put another cap on rates. But what is that going to do to the inflation side of things?
Yeah, no, I agree. And that's why this is such a nasty thing to kind of think through as far as the different scenarios. I want to go back to what you said around M&A in the metals, energy space, natural resources space for a moment. So I'm going to make the presumption that if M&A activity is going to pick up, it's going to be the cash-rich companies that don't rely on leverage to do the M&A transactions because interest rates are higher than before. Is there, for those that are looking for takeover targets, right? Or if somebody wanted to have that sort of style, looking at the natural resource equity space, what types of characteristics should one consider from your experience? Meaning, if somebody wants to identify potential takeover targets where there might be a merger acquisition, an acquired company, to try to say to themselves, okay, I want to look for these characteristics in a natural resource company to see if it might be a possible bio candidate.
Okay, so the main structural issue within the metals industry at large and mining is that the majors have underinvested massively in the capex and the exploration in order to make new discoveries, to build new mines. And there's many reasons for that. One of them is that in the last cycle they were spending like drunken sailors, and by 2010 there was a lot of money raised and spent and on projects that really that for the most part didn't pan out. And so management has been very conservative in this cycle. And so the fundamentals, the beauty of it is that the fundamentals right now for most of these companies is great. They haven't spent, so their free cash flow is high because the capex is low, and the reserves that they built up in the last cycle are in production now, and so these companies are making a lot of money, and the valuations are cheap because investors still don't care about this space, and especially precious metals, and so the valuations relative to that free cash flow are strong, dividends are strong, but the problem is that these guys are going to run out of reserves, and because they haven't been replacing their reserves, so they have no choice but to go buy other companies, the smaller companies that have been spending money on exploration, have been making discoveries, but they're going to they've let those other companies take the risk of investing. There's 2,000 publicly listed junior mining companies that are doing exploration focused work, and so there's no shortage of companies at least trying to make these discoveries, but still the quality among them is really difficult to discern, and that's why we hired Quentin Henney, who's we think he's the smartest exploration geologist on the planet. He worked the first half of his career for the majors. He worked for Homestake, which became Barrick. He worked for Newcrest, the largest Australian miner. He worked for Newmont, the largest gold mining company in the world. The latter half of his career, the last 15 years before coming to Crescat, he spent working directly for the smaller exploration companies. He was He's been a director of like 15 different companies since coming to join Crescat full time. He's resigned most of those directorships to focus full time and remove the conflict so he can help us. But how do we identify the companies that the majors are going to want to come and buy, because they have to buy our companies, otherwise they're not going to be able to. Otherwise they will not be able to increase their own production. We look for deposits, number one, that are in viable jurisdictions around the world where you can actually build a mine. And we stay away from Africa for the most part. We stay away from China, but we have a lot in North America, in Canada, in the U.S., and some in South America. We were in Mexico, but we've gotten out of Mexico. We like Brazil. We actually like Bolivia because that's an up and coming jurisdiction that's actually very mining friendly and opening up to foreign investment. And they host some major silver and base metal deposits. So jurisdiction is important. We're in Australia as well, and in some places in Europe. And the second most important thing is profitability and what I would call grade. So depending on the style of deposit that it is, you want to be focused on metallurgy, on stuff that can be turned into metal without a lot of waste, on either big disseminated deposits that might be lower grade, but they're big and the grade is high enough that the mine can be very profitable, or super high grade stuff that will make a really good underground mine. So the lower grade, big disseminated stuff, that's the open pit mines. The underground stuff, that is where you're looking for the super high grade veins and chutes that can become profitable underground mines. So there's different styles of deposits, but discovery is important. And the bigger companies just haven't been spending the money on doing the exploration work and the drilling. It takes drilling in order to prove out a deposit. And so we've been able to put money into over 90 different companies. About 50 plus of them we would consider activist positions, where we've been able to get between 5 and 25% ownership in a company at large. And we get the money to these companies so that they can actually do the drilling and prove out these deposits. Quentin is the expert. I mean, he was the one who designed the drill hole that hit the Swan Zone at Fosterville that literally made Eric Sprott over $1 billion. And so Quentin knows the movers and shakers in the industry. He knows the best companies. He knows the best deposits. We vet where we're going to put the money. We've got over 150 drills operating around the world, which is like 6 or 7 times the top 3 majors in the industry when it comes to greenfield drilling, exploration drilling. And so that's our approach. And I can tell you some of the names that we like that are already on to some major discoveries that we think are undervalued if people want to go there.
I think that's a good way to end the space. Everybody here again, please make sure you follow Kevin Smith and check out their various research posts he and Tavi put out. Always great perspective. Kevin, I appreciate you spending Sunday with us. I appreciate it.
All right, Michael, thanks. And if you want to know those names, just go to our website and give us a call. Check us out. Talk to Merrick if you're interested in learning more about Crescat strategies. All the information is up on our website at crescat.net.